my interpretation of Bitcoin is it's calling out there's not enough liquidity to support all of this right now. There is a ton of malinvestment going on, and there's a ton of people swimming naked. And so Bitcoin has pointed this out since the end of last year, and it's been sitting here waiting for a resolution. I call it this fiat liquidity smoke alarm. I think Bitcoin is going to rip people's face off if and when the US government de facto backs all of this garbage and says, whatever, OpenAI probably up, and who knows if they're going to be a good company, but they can't fail at this point. So whatever, screw it. Then Bitcoin, gold, all of these things are going to rip.
The market has spent the last 2 years cheering one story and ignoring another. On one side, artificial intelligence has become the center of gravity for global capital, attracting hundreds of billions of dollars in investment, speculation, and debt. On the other side sits Bitcoin quietly consolidating, refusing to confirm the euphoria, and flashing signals that something beneath the surface may not be as healthy as investors think. According to Jack Mallers, Bitcoin may be acting like a financial smoke alarm. While headlines celebrate record AI spending, massive data center projects, and trillion-dollar technology ambitions, Bitcoin has spent months sending a very different message. Not that innovation is dead. Not that AI won't change the world, but that there may not be enough liquidity in the system to support every promise being made. And when liquidity becomes scarce, excesses have a way of revealing themselves. That is why Mallers believes the next major move in Bitcoin could catch almost everyone off guard, if the debt-fueled AI boom begins to crack under its own weight. Or if policymakers decide that these companies have become too important to fail, the response could unleash a wave of money creation unlike anything we've seen in years. And if that happens, Mallers argues that Bitcoin and gold may not just rise, they could explode higher, as investors rush toward assets that cannot be printed. In today's video, we'll break down why Mallers believes the Federal Reserve is trapped, why America's debt problem makes higher interest rates increasingly dangerous, how AI companies are piling up enormous financing risks, and why all roads could ultimately lead back to Bitcoin. If you enjoy this type of macro and Bitcoin analysis, make sure to like the video, subscribe to the channel, turn on post notifications, and let me know in the comments whether you think the AI boom is sustainable or heading toward a reckoning. Now, let's hear what Jack Mallers had to say.
We have a big week because the Fed has an opportunity to change interest rates. And I just want to say something here. I've said there's no way Warsh hikes rates. That would be impossible. He'd have to be an idiot. And feedback for my own self, I got to be a little careful with such declarative statements like that, because inevitably when he does raise rates, then everyone's going to be like, wow, I listen to your show. You're an idiot. So let me just rephrase things quickly. I really don't think he should. I think it's a very bad idea. Mathematically, it cannot work. But that doesn't mean that he won't. I have to be honest about that because, we're dealing in a world of politics. And, this is all Ponzi-nomics. It's a woozy, it's a wazi, it's fairy dust, right? Wolf of Wall Street. And so I don't know, the politics and being in the war room and what's going on with Iran and AI companies in China. And so I can't make such declarative statements. So I just got to be clear on that. Now, I will walk you guys through once again why it just isn't an option for the long term, but it doesn't mean that he won't. And so the market is effectively pricing this week as a toss-up. So Trump today was very vocal with the media. So I got two screenshots here. Trump asked the Fed this week, costs are going down rapidly. And then Trump again, rates should be lowered. So Trump is sticking to his guns. He thinks, he also had one I didn't put in here. He thinks the US should have the lowest interest rates in the world. So Trump wants aggressive rate cutting. He always has. Seemingly, he sticks by that, which is also fine, but obviously is inflationary. And then this tweet from Feiju is really the visualization of what I was just describing, is that it's kind of a toss-up. The market is saying Warsh really might raise rates. Like, he really might do it. The way that he's talking and the way the market is pricing it in, it's a non-zero chance, which is why I had to get on here and say, I think it'd be a bad idea. He might pop the AI credit bubble. He might cause a lot of irreversible harm to equities and to the bond market. And that's when we're going to get like a big print bailout type of event. But he might do it. Because I don't, again, politicians, I don't know. I mean, it's the most irrational, ridiculous chapter in human history, arguably. I can't predict these things. And so this Fiju tweet reads, welcome to the new age. Rates being a toss-up going into meetings is the new normal. Expect volatility. So that's really my market update, is to expect volatility. So this from the Wall Street Journal, how sky-high deficits threaten the bond market. And I mean, we've gone over this a million times. Luke Groman has gone over this a million times. Every macro analyst has gone over this a million times. The slide on the left, or the visual on the left, is showing how the US Treasury has financed itself through bills as opposed to long duration. So, when people say short duration, long duration, it's you're issuing these debt notes, and what's the duration of the note? Like a 10-year US Treasury or a 30-year US Treasury. That's long term. That's long duration, right? Versus a 3-month bill. 3-month versus 10 years. One is short, one is long. Now, the US Treasury, so the US government, has been financing itself on the short end, issuing bills short. And they're doing that because the long end doesn't have enough demand to sustain the amount of debt that the government needs to issue because of the deficits. So the government wants to spend $2 trillion a year that it doesn't have. Okay, it wants to run a $2 trillion deficit. They would issue 10-year, 30 years if they could, but there's not enough demand for people willing to lend to the government over that duration. And so if there's a supply-demand mismatch in the bond market, which we've talked about all the time, remember bond math, yields go up when the bond value goes down, right? So if they're pushing a lot of supply to the long end and there's not enough demand to meet it, then they're going to break the bond market. Yields are going to go to infinity. And so the way that they've been able to subsidize the U.S. government, despite having really fragile U.S. Treasuries market, is by substituting the financing via bills. Okay, what are the consequences of that? Well, when you have to roll over all of this short duration, I mean, this is trillions of dollars. So on the right, you can see privately held marketable U.S. Treasury debt maturing within 1 year is now over $8 trillion. And so the point is, raising interest rates is like pouring gasoline onto a fire, because who is the person most impacted by a higher cost of financing? Well, the U.S. government itself.
Maller's argument is ultimately simple. Today's economy is carrying debt levels that previous generations never had to contend with. In a world where the U.S. government owes tens of trillions of dollars and relies heavily on short-term financing, interest rates don't just affect consumers and businesses, they directly affect Washington itself. That is why he believes aggressive rate hikes become increasingly difficult to sustain over time, regardless of what policymakers may want. But the debt story doesn't stop with governments. In Mahler's view, the same easy money environment that helped inflate public debt has also fueled an extraordinary wave of AI investment. And if AI has become the engine driving growth, stock market performance, and investor optimism, then understanding how that engine is being financed becomes one of the most important questions in the entire market.
This is credit risk across AI backers or AI financiers. So something that you guys need to keep in mind, and I'll say it every single week if I have to, AI is not financed out of profitable cash flow. These guys are borrowing an insane amount of money, and the biggest borrowers are companies that don't produce profits. So there is no path currently to pay that back. Now, obviously, you borrow money because you think your future will be worth more than your present. And so if that's true and they're able to produce loads and loads and loads of profits, good for them. But that's why Chinese competition seems to be like a knife to the throat of these guys, where they're like, ban that shit. Or I can't believe I'm saying open AI executives say open source is bad. I mean, you'd have to be some kind of up human with the moral compass backwards to say that open source is bad. But this is what these guys are saying. Why are they so threatened by China? Well, if China comes in and is even marginally competitive to their business, well, all of the profits that they were banking on somehow achieving in the future is severely threatened. Even if someone comes in and takes 20%, 30% market share in some, that's enough to have made all of the financing decisions that they've already chosen moot and totally worthless, right? So who are they borrowing money from? Well, we haven't gotten to a point where the US government in combination with the banks have been doing like large swaths of effectively government backed financing, which is that highly inflationary, pure money printing. That's when my interpretation of Bitcoin is it's calling out there's not enough liquidity to support all of this right now. There is a ton of malinvestment going on, and there's a ton of people swimming naked. And so Bitcoin has pointed this out since the end of last year, and it's been sitting here waiting for a resolution. I call it this fiat liquidity smoke alarm. I think Bitcoin is going to rip people's face off if and when the US government de facto backs all of this garbage and says, whatever, OpenAI probably up, and who knows if they're going to be a good company, but they can't fail at this point. So whatever, screw it. Then Bitcoin, gold, all of these things are going to rip. And the more time goes on and the more these questions are presented and the more trouble people get in trouble and the more China presents like legitimate technology threats in the AI sector to the United States, then the more like Bitcoin and other assets are going to chop around and fall. So who's lending the money today? Oracle, Microsoft, Amazon, Meta. That's what we're looking at right here. So this is Oracle, Microsoft, SoftBank, AMD, Meta, Amazon, CoreWeave, okay? Look at the credit risk across these businesses, which was, virtually nothing in the middle of last year outside of Oracle. And now they're all right. Like this trend is real. Now, it's not saying that these businesses aren't creditworthy, but I think the point is that the market is starting to assess this as one giant correlated bet that is not certain any longer. Okay. Meaning it's not as if like some of this might work out, some not. And, the risk is isolated over. It's like, no. It's like if this doesn't work out, like the risk is spread across all of these lenders. Nobody is safe. There's concentrated risk, which again, it continues to imply that there's probably going to be a government backstop, government bailout. And then today, one of the only companies that seemed to have a unique product that was cheap for them to produce relative to the cost they were able to sell it, cash flow out the wazoo, stock through the roof, Nvidia came out and said, they're going to guarantee $250 billion in financing to OpenAI. And I've been calling out OpenAI for a while now of like, they are not profitable. The path to profitability is not within the next half decade. So, I mean, what model is reliable that's further than 5 years out for a company that's not even 5 years old? I mean, what are we talking about? So the details include guarantees from Nvidia to help OpenAI lease a 10 gigawatt project that SoftBank is developing in Ohio. In total, the project could cost more than $500 billion. It's hard to say these numbers out loud. I mean, they're just so preposterous. Cost more than $500 billion, the largest data center project ever announced. The power for the project is controlled by the US government and funded separately by Japan under a recent trade deal. Signpost. Commerce Secretary Lutnick is reportedly involved in deciding who will get the power. Interesting. The data center build out just hit a whole new level. Now, Nvidia, I have on the left, don't forget, is the largest weighting in the S&P 500 right now. Their credit risk jumped tremendously. It looks like it jumped 40 basis points, over 100%, just based on this announcement today, and the stock got hammered. The whole stock market got hammered because of these decisions. Jim Chanos writes, so we're at the point in the cycle where Nvidia has to provide financing guarantees for roughly 2/3 of the cost of the chips it is selling to the data center project. And then he follows up to that and says, just so you have an idea of how immense that figure is, it represents 135% of Nvidia's total retained earnings. I mean, these are gargantuan, preposterous numbers. And what we're seeing is the financing of all of this keeps getting pushed further and further down the stack until you get to the US government. So now Nvidia is the lender of last resort. And how long until they're deemed not creditworthy?
What makes Mahler's thesis so compelling is that it connects several stories that investors often analyze separately: government debt, Federal Reserve policy, AI spending, bond market stress, and Bitcoin are usually treated as different conversations. Mahlers argues they are all part of the same story, and that story revolves around liquidity. If the AI revolution generates the profits its supporters expect, then many of today's concerns may eventually prove overblown. The enormous investments being made today could be justified by even greater economic gains tomorrow. But if the returns fall short, if competition from China compresses margins, or if financing costs continue to rise, then the risks embedded throughout the system could become impossible to ignore. That is where Bitcoin enters the picture. Mahlers sees Bitcoin as a market-based warning signal, a real-time indicator that the financial system is becoming increasingly dependent on debt, leverage, and future promises. And if policymakers ultimately decide that the AI race is too important to lose, the solution may not be allowing failures. The solution may be more liquidity, more intervention, and more money creation. Whether you agree with Mahlers or not, one thing is becoming increasingly difficult to dismiss. The amounts of capital flowing into AI are unlike anything we've seen before, and the stakes attached to its success have become enormous. If the industry succeeds, it could reshape the global economy. If it struggles, the consequences may ripple through financial markets, government policy, and the future trajectory of Bitcoin itself. If you enjoyed this analysis, be sure to like the video, subscribe to the channel, and share it with someone who follows Bitcoin, AI, or the broader macro economy. Thanks for watching, and I'll see you in the next video.